Welcome back to Real Clear Radio Hour, brought to you by the Competitive Enterprise Institute. I'm your host, Bill Frezza. We're pleased to welcome Jerry Jordan, past president of the Federal Reserve Bank of Cleveland, adjunct scholar at the Cato Institute, and the author of The New Monetary Framework. Jerry, welcome to the show.
Glad to be with you, Bill.
Jerry, you and I have been pen pals for a while, and I've learned so much from you. I finally convinced you to come on the show by promising to focus our conversation on a paper of yours that's just been published in the Cato Journal titled The New Monetary Framework. I recommend it to anyone who's trying to figure out what in the world the Federal Reserve is doing. You open your paper with a question. Do the policy actions of monetary authorities actually affect economic activity? As a former Fed bank president, isn't this blasphemy and sedition?
No, actually not at all. And in a way, the title of the paper is potentially misleading. I didn't give it that title. The editors did. Because this paper is not suggesting a different kind of model for how central bank actions affect economic activity. Its intent is to attack the prevailing views of the way central bank actions do anything at all. When I started working in the central bank almost 50 years ago, there was a prevailing view at the time of how actions by the policymakers did affect something, inflation, employment, anything that was concerned about. And the first task for analysts was to address the flaws in the prevailing views. It's the old, if it ain't broken, don't fix it problem. And that's part of what I'm trying to do in this paper, is to address the way people think that monetary policy works or has worked in recent decades in order to get them to open up their minds to think about a new way of approaching monetary issues.
Well, you certainly got me reeling with this paper, which is why I got so excited about having you on. You state that under our current interconnected global financial system, the size of the central bank balance sheet does not affect the nation's money supply. I mean, this was true in the past, and if it's not true now, that goes a long way toward explaining why we haven't seen much inflation. But how did the connection get severed?
Well, it was a gradual process starting with the financial crisis of 2008, and especially the payment of interest on reserves, which was a new innovation, and then what they came to call quantitative easing, large-scale asset purchases by the central banks, ballooning up total assets and therefore total liabilities of central banks. And in that process, over the last several years, any connection between what we call the monetary base, the balance sheet of a central bank, and the nation's money supply has completely broken down. And that's true not just of the United States, but of all of the other major central banks in the world.
Jerry, you posit a two-part test on how money gets created under today's fiat monetary regime. You state that it's a function of loan demand and securities on offers to banks. I understand the first part. That's a simple supply and demand observation. But how does the second part work? Why do the securities on offer to banks as collateral make a difference?
The issue of collateral used by commercial banks has to do with bank-to-bank kind of transactions. And banks have to post collateral to each other for a lot of the things that they do, especially what we call these days the shadow banking community. And many things can serve as collateral. The best quality is U.S. Treasury securities. But until just a few years ago, a whole lot of other things also were viewed as basically riskless assets, and commercial banks could use them in their transactions with each other. That changed dramatically in 2008 with the financial crisis, and a lot of things that were previously acceptable collateral went away. The obvious ones are the securities of Fannie Mae, Freddie Mac, which were nationalized, became government entities for the most part. And so the quantity of securities that are floating and available around there dropped by about 1/3, something on the order of about $7 or $8 trillion overnight. So that tightened up, in a sense, the credit markets. But that was not related to what the Federal Reserve was doing before. It was the Federal Reserve's subsequent actions that did have an effect on that available supply of securities that can be used as collateral.
Well, you note in your paper that central bank buying of government bonds or quantitative easing is the equivalent of early retirement of outstanding national debt, which I guess is something we could celebrate. But you observe that draining large amounts of this riskless collateral is contractionary, which is the exact opposite of the intended stimulus effect of QE. Did this come as a surprise to central bank officials?
I would think it was a surprise to both the people in the central bank currently and to people like myself as former employees of our central bank or other central banks around the world. Decades ago, a congressman that was regularly overseeing the Federal Reserve from Texas, Wright Patman, used to say you could burn the bonds owned by the central bank and no one would know the difference. Because when the central bank acquires a government bond, it is effectively canceled because the interest paid by the Treasury to the central bank on those bonds is then returned to the Treasury in a different route, and so it effectively cancels out on consolidation. So the net national debt has gone down by the amount of any bonds bought by the central bank.
When it comes to the supposed stimulus effect, the QE was almost self-canceling.
It didn't do much of anything. The way to think about it is to ask, what does the central bank do that could not have been done by a bureau of the Treasury Department? Suppose the Treasury had gone to the Congress and said, we want to buy $1 trillion of our own longer-term government bonds. Congress is going to say, well, okay, but how are you going to pay for that? And they say, well, we plan to issue one-week Treasury bills in order to buy 30-year Treasury bonds. And Congress then appropriates the money in order to do that. And they buy the bonds and then effectively cancel amount by issue short term. That would change the term structure, the duration or the maturity of the government debt outstanding, but it doesn't do anything else as a result. They do it in the central bank for very straightforward reasons of not needing to go to Congress, but the effect is the same thing as if the Treasury had bought back its own long-term bonds by issuing short-term bonds.
What happens when central banks buy private securities, either mortgage bonds the way the U.S. Fed did, or corporate bonds like the European Central Bank seems to be doing now?
That's a fiscal action by government to acquire any private assets. And again, the way to think about it is if the Treasury went to Congress and said, we want to buy mortgage-backed securities, or we want to buy the stock of some corporation, we want to buy up Google stock, a lot of people would have trouble with that. But it involves an appropriation by Congress, in our system at least, and the government acquires an asset, mortgage-backed securities, common stock, state and local government bonds, it doesn't really matter, and they incur a debt. They issue, say, Treasury bills in order to pay for it. Those Treasury securities that they issue would come under the debt ceiling limit. That creates a political problem within Congress, but also it creates a problem in the minds of a lot of people. Do we really want the government acquiring private assets like that? When the central bank goes into the market and buys mortgage-backed securities, or the European Central Bank buys corporate bonds, they're doing exactly the same thing as if the Parliament or the Congress voted to nationalize these companies by buying their stock.
That's pretty frightening.
Very dangerous precedent.
What do you make of the hypothesis that zero interest rate policy works by pushing down bond yields so investors are driven into equities seeking higher returns, which therefore creates a wealth effect that stimulates consumer spending, that fuels aggregate demand, that makes the economy grow? What do you make of that?
Well, I don't think there's any validity to it, though it's probably the most commonly held view of the way central bank actions, or sometimes even fiscal actions, work, is that there is some notion called aggregate demand, total spending on things, and that somehow over at a point in time there's not enough of this demand that's occurring naturally, and so it's the government's job to prime the pump, to create demand, and you can theoretically do that by money supply increases or increase in credit availability, or by fiscal actions, by printing up coupons to send out to people to spend. The actions by the Ford administration back in the 70s was an example of that. Let's just send everybody a tax rebate, and they'll go out and spend the money, and the order books will fill up. The businessmen will have confidence. They will go out and order more stuff, build up their inventory, hire more workers, and somehow that expands the economy.
Has that ever been true?
No, I don't buy into the theory at all. But that idea about managing aggregate demand became predominant in the 1960s, and most of the time since then has been the conception by which most people analyze what's going on with either monetary policy or fiscal policy.
Wouldn't that be something that Adam Smith would have laughed at?
Yeah, the very notion that there can be an inadequacy of demand is sort of like unsatisfied consumer wants. It just doesn't make any sense to me. If the price of something declines, people are going to increase the amount of it that they want to buy. The example I use in the paper is if a weekend fly around Mars, the price drops dramatically enough, the amount demanded of that is going to increase. So the question really is, what is the private sector doing to reduce the costs of something so that people want more of it? We see it all the time in cell phones and digital TVs and all kinds of electronic goods and various services. When the prices fall, people buy more of it. But the broader conception of the economy to many people is that somehow there's wants that have to be stimulated by government action.
So, Jerry, getting back to the Fed balance sheet, what are the implications of the fact that something like half of the interest-bearing reserve balances at Federal Reserve banks, maybe $2 trillion, are held by foreign banking entities operating in the U.S.?
Well, this is something that has not received very much attention and needs to be further analyzed. Starting with the payment of interest on reserves in the fall of 2008, an unanticipated development was that simultaneously foreign bank supervisory authorities were telling their banking companies that they need to hold more liquidity, and especially if they operate in the U.S. or globally in the dollar market, meaning they have obligations to supply dollars to people, that they had to have access to a source of dollars. And the highest quality source of dollars for commercial banks, say a German bank, French bank, and so on, is a deposit at the Federal Reserve in New York or one of the other reserve banks. So we saw a massive increase in the dollar-denominated deposits of these foreign companies around the world, but especially those that are operating in the United States, in their balances at the Federal Reserve banks, and the fact that they were receiving interest, 25 basis points for the first few years, was just a bonus to them.
So what are the implications of that?
It's part of what I think of as a broader globalization of the use of dollars around the world. You could think of it as a de facto dollarization of all goods and services transacted in the world. We're used to seeing individual countries, say El Salvador, Ecuador, other countries, unilaterally just give up their own currencies and say, the heck with this, we're going to dollarize, meaning we're going to just use the money supply provided by the United States as though it was our own currency. What we're seeing now is that people from around the world, both individuals in holding U.S. currency and foreign banking companies in holding a large portion of their assets in dollars, whether deposits at the Federal Reserve banks or various securities denominated in dollars, are moving sometimes gradually, sometimes at a quicker pace, to simply dollarizing their whole balance sheet. I think it's a long-term trend, and it may ultimately wind up that the dollar is the only remaining currency that is universally used. The implication of that is that any actions by our central bank has to be viewed in a global context, not just within these 50 states and our GDP, but rather it has to be viewed in terms of global production, global investment, global savings, global consumption, because dollars are used globally.
Well, when Greece tied itself to the euro in a similar situation, that didn't work out too well for them.
Yeah, Greece is a very interesting case because they incurred a lot of obligations to pay euros to people that wanted to invest in Greece, lend in Greece, but without the ability to generate euros by exports in order to service those debts, to pay the interest, pay the dividends, and eventually pay back the principal on those loans and investments. And that's because the Greek economy, the productivity is so much lower than their trading partners, especially, say, a country like Germany, that they're just not competitive, but yet they're wedded to the same currency. A way to think of it would be if a very poor, backward part of the United States, someplace in Appalachia or certain parts of, say, a state like Mississippi, finds that they're just not productive, they're not competitive with the rich parts of the United States, and they said, we want to have the same wages that they have in New York or California, but we can't produce and sell, so we want to devalue the currency. We want a cheaper currency. That's the way it used to be done before Greece joined the euro. Once they joined the euro, they could no longer devalue their currency. The only thing that could happen is that Greek wages had to fall to be more in line with the productivity of Greek workers, and of course that's a political issue.
As we're watching this journey through Alice's looking glass, I have to ask, how in the world did such a thing as negative interest rates come around, and what are its dangers?
Negative interest rates occur in two different ways. The one way that is most common, and the way it gets started, is the central banks, Japan as an example, Switzerland, they impose a negative interest rate on the deposits of commercial banks at the central bank. The way to think about that is a tax, that whatever the amount that the commercial bank deposits at the central bank is subject to an ongoing tax, and that the commercial banks are willing to do that either because they're under a supervisory mandate, a regulation requiring that they hold those balances, or a precautionary capital preservation motive. Whatever it is, it really is a tax on the banking system, meaning the stockholders, investors of the bank, and that's going to be passed on. And that causes commercial banks to either not grow at all or to maybe even to shrink in their size, looking for alternatives. Take their balance out of the central bank and hold it in some other form, in currency, or move the balance someplace else if they're allowed to do so. That all shrinks the banking system, and anything that's a tax on banks and causes them to either not grow or to shrink has a negative impact on economic activity.
What's going to happen to the value of the trillions of dollars of negative interest sovereign bonds out there when interest rates return back to normal?
Well, any increase in market interest rates is caused by a decline in the price of those securities in the market. There's a confusion about the way interest rates work on bonds versus interest rates on deposits. A great many people think of the interest rate that they get on a CD in a bank. If that goes up or down, the amount of their principal, the value of the CD, has not changed. They're just receiving more or less interest on it. But that's not true in the case of a bond. When the interest rates on bonds fall, it means the price of the bond has gone up. And the inverse has to be true also. The way interest rates on bonds in the marketplace rise is the price of bonds in the market falls.
Jerry, there was a time when both the public and most economists believed that inflation was bad and that stable currency was nirvana. And now both the Fed and many economists believe that 2% inflation is a magic panacea. What accounts for this change in attitude?
It's not a change in the sense that it's a new idea, but rather it's an acceptance on the part of the people who advocate more inflation that there's something called wage rigidity or wage stickiness. And their view, if you probe them hard enough, is that wages are too high. The nominal wages that people receive, their paycheck, is more than is appropriate given their productivity and the value of what they produce. And their wage should therefore fall. But because wages are sticky, or because there's union contracts, or whatever is the reason, nominal wages don't fall. So that policymaker advocating inflation is saying we need to cause real wages to go down by way of inflation. We erode the purchasing power. You still get $20 an hour, but it just won't buy as much as it used to, and therefore your real wage has fallen. So all of the people that are advocating more inflation have this idea of you're lubricating the skids for growth by causing real wages to go down, and they think that that's a good thing. They just don't want to say that.
So in other words, Janet Yellen wants everyone to take a pay cut.
She wants a lot of workers who deserve to receive less, in her view, than they are, to be subject to a money illusion, that they still get the same paycheck, but it just doesn't buy as much.
I recall when a 4 to 5% unemployment rate was considered full employment, which fulfills one of the two Fed mandates. Well, we're there now. And the other Fed mandate is to keep the currency stable, and right now we're there. So why can't the Fed declare victory and restore the federal funds rate back to its historic norm of, 3%?
Well, that's a two-part question. Taking the last part first, they have no direct ability to influence the federal funds rate anymore. That ended about 5 years ago in the summer of 2011 when they no longer had the portfolio of securities to sell to raise the Fed funds rate, and they were abstaining from buying in the market, trying to lower it. So they have no direct effect and have not had any direct effect on the federal funds rate, the rate at which commercial banks lend overnight to each other, for at least 5 years now. As on the unemployment issue, even though the unemployment rate has fallen over the last several years down into the zone of 5% or below, it's almost entirely because of people leaving the workforce. We now have a lower participation rate in the workforce than any time in the last 40 years. And most of that decline in labor force participation has been in an older age group, and it's been in men as well as women, though predominantly in men that otherwise would have been working. So we, in a way, have this reservoir of people that are not counted as unemployed in the official statistic, yet they're not working. And so potentially, if there's any increase in the demand for labor, then they can come back into the labor force looking for a job because now it's worth their time to do that. So that low level of unemployment that's reported doesn't have the same implications that it did when there was a much, much higher participation rate.
So everything is flexible now. The value of the dollar, the value of the unemployment rate. What has stayed steady through all this?
Well, even though superficially interest rates are low and relatively stable, and the consumer price index is low and fairly stable in recent years, I think most people look at those two things and they're not happy about the low interest rates if they're savers. They don't think that that's a good thing, especially if they're target savers needing to acquire certain stream of earnings over time. That's true of households as well as it is institutional investors like insurance companies, life insurance companies, pension funds, and all of that. If they're getting less and less interest on the given amount of investment, but they need more income for future obligations, then they have to be paying higher and higher prices for those securities. And that's part and parcel of why we have such a low interest rate structure. The inflation rate, to a lot of people, their personal inflation rate is very different than those official statistics. The official statistics include things like the price of cell phones or new flat-screen LED TVs and all sorts of things that people only buy every few years at best, whereas often what's excluded from the consumer price index are things like food, gasoline, things that people buy on a daily or a weekly basis, and that's the way they gauge inflation.
So you indicated that the Fed can control the federal funds rate through open market operations. What new policy tools are supposed to replace it?
In the last few years, authorities have announced new tools and techniques that they hope to have some influence over the level of interest rates. They don't really claim to have any influence anymore over the money supply or availability of bank credit. They're simply operating on a view that the way central bank actions work is by higher or lower interest rates. And so by paying interest on reserves, or as they did in December of last year, raising the amount of interest that they're paying to commercial banks to deposit with them, they created an arbitrage opportunity so that people in the daily overnight markets can bid more for the excess funds of some entities like Federal Home Loan Banks and deposit that money in the central bank in order to earn more interest, an arbitrage. And that's their only way to try and influence the overnight interbank rate.
If inflation or hyperinflation finally gets ignited, is the Fed going to be able to control it?
The idea is that they could always raise the interest rate that they pay on deposits or use these other tools, what they call reverse repurchase agreements, which is essentially just borrowing from the private sector, and pay a high enough interest rate to discourage people from consuming or investing. First, there's no historical evidence that that model works. No one has ever tried that before, and no one has any idea at all about how high interest rates might have to go to discourage spending by households and businesses in order to dampen down the inflationary pressures. So my view is that although the central bank has failed in its objectives of trying to cause higher inflation, that if for whatever reasons inflation were to start to occur at a faster and faster rate, the tools that they claim to have available in order to try to dampen emerging inflationary pressures have never been tried, and we have no idea how they might work or not work.
Does that frighten you?
It's a source of concern, and therefore we need to be thinking about alternative monetary arrangements to try and restore some ability of central bank policymakers' actions to influence economic activity. What I've been trying to say in this and other papers is that the old ways of thinking about how central banks influence the economy are no longer working, and we need to focus our minds on trying to find new ways that might get better results in the future.
What about old ways? Is there any chance of the U.S. or any other major country returning to some sort of a gold standard, as Steve Forbes has been arguing?
A gold standard cannot be adopted by any one country unilaterally, not even the United States as big as we are, because a gold standard in the true, pure gold standard sense, 19th century, means that the central bank and that the Treasury is standing ready to buy or sell gold at a fixed price to all comers, domestic or foreign, and picking that price at which they're willing to buy gold or sell gold is limited by either their knowledge is simply not adequate to do it, but also the availability of the gold stock. It just cannot be done. You could imagine an international agreement like Bretton Woods at the end of World War II, where the countries all get together and they agree on something and peg it. You can imagine in the classroom I can do it, but in the real world I don't think so. In the Smithsonian Agreement in December of 1971, the Nixon administration agreed with the other countries that we would change the official price of gold from $35 to $38. That only lasted a very short period of time. It wasn't working at all. So they changed the price again to $42.22, and that's where it remains today. We do have a gold price that's official, $42. And it's the price that the government will not buy and will not sell gold. Some of the advocates of gold say, well, let's change the price again. Let's make it $1,500 an ounce. But if it's $1,500 is the price at which the government does not buy and does not sell, it has no meaning, no more than the $42. So they have to flesh out those proposals as to government actions in order to really peg the price of gold. And if they think that they know how to do that, they know a heck of a lot more than I do.
Jerry, summing this all up, it sounds like the central bank authorities are adrift. What advice do you give to individuals who want to protect themselves from what could be a coming hyperinflation?
Well, I don't give advice as to how to protect themselves. People have to watch their debts and acquire real assets, and that means try to be very, very conservative in their real estate investments financed by little debt. People that get themselves into trouble are not the people that have assets, but they are the people that have debts that cannot be sustained when their source of revenue to service those debts, money coming in, is not adequate to pay the interest or to return the principal. And that's true of a country like Greece as it is to a household in America.
Jerry, you're far too sensible. I really appreciate having you on the show. We'll be checking back with you from time to time. Thanks for joining us.
Nice talking with you, Bill.
That was Jerry Jordan, past president of the Federal Reserve Bank of Cleveland, adjunct scholar at the Cato Institute, and the author of The New Monetary Framework, here on Real Clear Radio Hour, brought to you by the Competitive Enterprise Institute. I'm your host, Bill Frezza. You can check out Real Clear Radio Hour on Facebook or follow us on Twitter at Real Clear Frezza. And while you're at it, take a look at realclearmarkets.com, my go-to place for diverse views on political economics. To make sure you don't miss any of our shows, stop by realclearradio.org and sign up for updates. Build your brand by aligning it with high-quality content on Real Clear Radio Hour. For corporate underwriting opportunities, contact producer at realclearradio.org. That wraps up our show for this week. Please join us next week, same time, same station. See you then.